Number 3, understanding the numbers of your real estate deal. To understand the numbers, you got to understand what types of returns that you're looking for. Now, I kind of hinted at this earlier, but I'm gonna make this very clear now. When I invest my money in real estate, I do not invest my money for appreciation because that's unpredictable. If I bought a property today for $200,000, I have no idea what it's going to be worth 12 months from now. Sure, I can make predictions, but the market could crash, the economy could crash, the economy could boom, the Fed could change interest rates, a pandemic could hit. A lot of things can happen, and that creates a lot of uncertainty in the appreciation of a property. So I don't like buying a property with the hopes of trying to sell it for profit, because if I'm doing that, now I'm trying to make my money based off of hope, and I don't like doing that. So when I invest my money in real estate, what I'm looking for is cash flow. Those are the numbers that I make my decisions off of. I want to be in a good neighborhood where the population's growing, where businesses are moving in. That way I can see the most appreciation. I mean, appreciation is nice, but I look at that like the icing on the cake. I don't make my decisions based off of the future potential value of a property. I make my decisions based off of how much cash flow can I generate, because that's much easier to calculate, that's much easier to predict. Now, the cash flow that you're going to generate, the returns that you're going to get are going to depend on the economy, and it's also going to depend on the area which you're investing. Like back 10 some years ago when I started investing my money in real estate in the Metro Detroit area, because, well, we're in Detroit, I was turning down deals that were making a 15 to 20% cash on cash return because those were not good enough deals at that time. Back in that time in 2011, 2012, 2013, if a property was not making 20+%, it wasn't worth my investment. Now, I was not a very sophisticated investor back then because I had no idea what the heck I was doing, but what I knew and the math that I was doing was if a property cost me $50,000, I want to get my money back in 4 years. Then the market started to change around 2015, 2016, 2017, and then again in 2020, 2021, 2022, 2023, 2024. And now, what I look for when I go out and invest my money in real estate is a 7% cash on cash return. Meaning for every dollar that I invest, I'm looking for 7 cents worth of cash flow, worth of profit from my real estate investment. Now, again, this cash flow is going to vary neighborhood by neighborhood. If you're in Manhattan, you are not going to find a 7% cash on cash return. You're looking for a 1% cash on cash return. So if you invest $1 million, you're trying to make $10,000 a year of profit. So neighborhoods across the country are very different, but what I'm looking for is growing populations, growing business areas, nice neighborhoods where I can get the 7% cash on cash return. And yes, this does exist today. Now, that might mean that you have to look outside of California. That might mean you have to look outside of Miami. That might mean you have to look out the area that you're in. But let me tell you something, Detroit is a great place to live. Metro Detroit is a great place to be. And so, well, this is a little pitch for Michigan, but here's what the numbers look like. Now, in the beginning of this video, I showed you that $100,000 property that Zillow says would rent for around $1,500 a month. But let me give you kind of that typical property that you're seeing nowadays, which I would consider a pretty decent return. You buy a property for around $165,000, and then it probably will need a little bit of work because I like to have my rental properties be nice and kind of that top of the market in terms of the quality of the property. So even if it's in really good condition at $165,000, I'm still probably going to put in another $15,000 worth of work, meaning my total cost in this property is $180,000. Let me try this black marker. This is starting to fade on me. Oh yeah, there we go. $180,000 cost to buy the property. Now at $180,000, I would want to rent this property for at least $1,800 a month, if not $1,850 or $1,900 a month, depending on the area. So let's assume now you're renting this for $1,800 a month, and yes, you will be able to rent this out all day and night long at $1,800 a month for this property in good condition, in a good area with growing populations and growing business. From here, you got to subtract your expenses, big things like your property taxes, your insurance, your maintenance, your management, because I am not going to manage the properties myself, and then any other fees that you might have coming up, and your mortgage if you're going to go out and take a mortgage. So let's assume now, for the purposes of this example on the first part, that you're doing this deal all cash, that you're not getting a mortgage, because as we know, mortgage rates are more expensive. So let's assume right now, we'll talk about mortgage in just a second, that you're buying this property all cash. That way we can do a fair assessment of the types of returns you'd get on your cash investment, assuming you bought this property without any debt. So if we just put some rough numbers on this, people like to call this the back of the envelope or back of the napkin numbers because these are just super rough numbers. If we say $180 a month for property taxes, another $150 a month for your property insurance, another $150 a month for your maintenance, and hopefully it'll be less, especially for the first couple of years because, well, I want to make sure this property is in tip-top shape, so hopefully very little maintenance, but let's just assume $150 a month in maintenance and then another $150 a month in management fees because you should be able to get a property manager for around 8%. This leaves you with $1,170 a month in profit, assuming that you bought this property all cash. Now, what type of return does that mean? I had to pull up my calculator for this one. So now, if we take $1,170 and we multiply this by 12, that means your annual income after this property is renovated, after you get a tenant in there, is $14,040 a year. That is your annual projected income. Might be a little bit more, might be a little bit less, but just a kind of rough idea. Now, if we take this $14,040 and you divide it by the $180,000 you had to invest to get this property, this is a 7.8% cash on cash return. Meaning if you put in $180,000, you're getting 7.8% in yield from your cash flow. We're not talking anything about appreciation. If this property goes up in value, that's the icing on the cake. If it goes down in value, oh well, you're still getting the 7.8% yield on the cash that you're investing based off of these numbers. Now, of course, there are variables. You could get a bad tenant. The tenant could destroy your property. You can get a bad property manager. I've dealt with all those things, but this is kind of the ideal number now where this property now makes sense to consider investing in. Now, if you don't have $180,000 saved up to go and buy this property all cash, what happens if you get a mortgage? Well, let's run through those numbers. Let's assume that you put down 25% in equity, 25% down, because I'm not a fan of over-leveraging, because over-leveraging can be very dangerous, and it's also very profitable for the people that are buying your deals after you get foreclosed on because you took on too much debt. That's how I found some of the best deals that I've invested in. It's somebody who goes on, takes on way too much debt, they don't know what they're doing, and then they get foreclosed on and the bank has to sell your property for pennies on the dollar. So let's assume you put 25% down. That means that you are going to be financing $135,000. This is the mortgage side. So you finance $135,000. Let's assume that you get a 7.5% interest rate because, well, interest rates are higher now than they were a few years ago. That means your monthly mortgage payment on this is going to be $944 a month. Now, again, you're making $1,170 a month after expenses before your mortgage. That means net you're making, had to get my calculator again because there's a lot of pressure when you're watching me on YouTube, but that means you're making $226 a month after paying your mortgage payment. Now, what does this mean in terms of your return on the cash that you invested? So now, you take this $226 and multiply it by 12. That means that you are making about $2,712 a month, assuming everything goes well, which, yes, of course, it is an assumption, but you got to run your numbers based off of something. So, you're making $2,712 a year, not a month. You're making $2,712 a year from your income from this property after your mortgage. I told you, YouTube puts a lot of pressure on you. Now, how much money did you invest? You bought the property for $180,000. You borrowed $135,000, which means you put down $45,000 yourself. So now, if you take this $2,712 and you divide it by the $45,000 that you had to invest out of your own pocket, that means you are getting a 6% cash on cash return on your money here because you put down $45,000. This $2,712 a year that you're making is a 6% yield, dividend, rental income, cash flow, whatever you want to put on it. It's a 6% cash on cash return of money that you're getting based off of the $45,000 that you invest. Again, this is focused solely on the cash flow, but then on top of this, you also get your tax breaks because remember, you get your depreciation deduction. So you get to also pay less money in taxes. In this instance, you'll probably be paying no money in taxes on your rental income because, again, if you do the depreciation deduction on a $180,000 home, you subtract the land value, then you take the property value, divide it by 27.5, well, you're probably going to have a loss on paper. Now, you have cash in the bank, you made a profit in terms of how much money you made, but when you report it to the IRS, you're showing them a loss, which can be carried forward. So if you start making bigger profits in the future, you still get to pay no taxes because you can carry forward that loss. Here, if you're making, $14,000 a year, you're probably still going to be paying taxes, but it's going to be a lower amount because you get the depreciation deduction. If you enjoyed this clip and you want to continue your financial education journey, I have another video that I think you'll love. All you got to do is click that button right over there. And for those of you who want to stay up to date on the top finance and business news, you can join Market Briefs, my free financial newsletter, by clicking that button below. Thank you for watching, and I'll see you in the next one.